Hola mi gente, welcome back to the channel. My name is Sean. This is We Are Investing, a channel that's dedicated in investing and personal finance. On today's video, we're going to dive into put options. We'll dive into the details of what put options are, how to trade them, key things to look at, and we're going to do this by going over a live trade that we just executed. So we're going to be providing you with real examples of what to look for in put options and the kind of returns that you might expect in trading put options. Now this is going to be a video tailored towards beginners. We're just going to be diving into buying put options. We're not going to dive into selling put options or doing cash secured puts. We're only going to talk about buying put options. Now we're going to be doing this today on Webull. We're going to hop on over to the mobile device and I'll show you everything when it comes to put options and some key things to watch out, because we're going to talk about some things that a lot of tutorials miss, and these things are super important, and we're going to go through the calculations to show you how it can impact your put options, and typically it's not a good thing. These are things that you want to avoid. But with that being said, this channel is focused on providing you material regarding investing and trading in the stock market. So if that interests you, then definitely consider hitting that subscribe button, ringing that bell, and smashing that like button so that you stay up to date and informed on how to trade or invest in the stock market. Let's hop on over to the mobile device on the Webull application and let's get started. Now, if you're interested in trading options, which you probably are by watching this video, just know that Webull charges $0 in commissions for options trading. In addition, Webull also offers great extended hours trading for stocks, starting at 4 a.m. and closing at 8 p.m. Eastern time. It's one of the best out there, and this is a great brokerage for beginners when it comes to trading stocks and options. And there's a ton of information provided on the application as well, so you can do a lot of research. Now, I want to show you the trade that we did, not to brag or anything like that, but I want to show you some key things to look at and why I did it the way I did. Now, this was posted on the private Discord, which you get access through the Patreon. A link is provided down below. It is through this Discord on this channel, member activity, where I post all of my trades and other members do as well. We try to be as transparent as we can on the Discord server. But taking a look at the trade, we bought put options on DPRO for the April expiration date at the $2.5 strike. We bought them, as you can see here. Here's my fill order. We bought them, and there are a few things that I want to show you here. We bought them for 40 cents, so $40 per contract, because you times the premium by 100. But one of the main things to focus on here is the time that the order was filled, and that's 11:20 a.m. When buying call options or put options, you don't typically want to buy them right when market opens, because implied volatility is going to be the highest and you're going to be paying the most for those call or put options. The stock can stay flat and you'll see the put option or call option come down in price just because of time of day and implied volatility. So I never think it's a good time to buy a call option or put option right at market open. However, on the flip side, because implied volatility is high at market open, it's a good time to sell put options. So here you can see my order being filled. This is my sell order, and this order got filled at 9:36 a.m. Eastern time, so 6 minutes after market open, and it got filled for a price of 60 cents or $60. So I made $20 per contract here off of a $40 contract, so I made 50% in just one day. Now, I wasn't at the computer at the time, or I wasn't looking at the stock or the option price on my phone. I just set my limit order and it got filled. I could have probably sold this for a little bit higher, but 50% gains on this trade was something that I was willing to take and I was happy with. So I knew that there was a good chance that I could get an order filled at market open, and I probably wasn't going to be available to monitor this position at market open. So I knew that I had to get a sell order in place just in case the put option was to go up. But it's important to know here that it got filled at 9:36 a.m. during market open, or right after market open, when implied volatility is high. Also, it's important to know that this was a one-day trade and I did not want to hold these put options for very long because of how high implied volatility was, and there could be an IV crush. This is something that a lot of people forget to look at and can have huge impacts on your put options. If you look at the options chain right now, we'll just look at the one that I bought. So I bought put options at the $2.5 strike. If I scroll over and we take a look at implied volatility, it's 190.84%. That is huge. Implied volatility is super high because if we take a look at the chart and we look at the 5-minute chart and we zoom out, we can see that the stock saw a massive pop in the share price. It went from $1.75-ish per share to a high of $3.75 in just one day. So this stock had a massive spike. We also can take a look at volume, and we can see that volume was also massive. For the at open, volume was 35 million shares. The day before, volume was barely anything, 14,000 shares for a 5-minute candle. So we saw a huge spike in volume. When I got my order filled, however, volume did come down a little bit. My order was 1115 and volume was 2.29 million shares. Now, we're going to dive a little bit more into the options, but how did I even find this stock? Well, on the markets tab in Webull, there are a few things you can look at. You can look at top gainers. This stock was on the chart or on this list when that happened. And you can also look at most active in volume. The stock was on the list as well that day, which was yesterday. But heading back to the options chain, and this is something that I want to focus on because I think so many people overlook this or don't even understand this. Implied volatility is 190.84% for this put option. Let's go to a different stock, a stock that is somewhat volatile, Tesla, and let's look at options for them. If we look at options for them that expire around the same time, April 14th, we get to put option and we look at implied volatility, we're at 61%. What does this mean and how can this impact your put option? Let's go back to DPro. And this might be a little confusing, but I'm going to try my best to explain this to you. Let's go back to the options chain. We look at implied volatility, 190.84%. What does that mean or why does it matter? We got to look at one other thing, which is Vega. Vega is 0.0024 for this put option. What is Vega? Well, Vega is the increase or decrease that the premium is going to see per 1% change in implied volatility. So the premium for this put option is 40 cents. You are going to see a 0.0024% drop in the share price for every 1% that implied volatility drops. How does that impact or why is this so important? Well, implied volatility is 190.84%. If we were to say that realistically, implied volatility could drop a lot and we could see implied volatility like Tesla stock, so going from 190% down to 80%, that's a 110% decrease in implied volatility. We need to times that by Vega, which is 0.0024. You're looking at a premium that's going to be $14. So $40 minus 14 divided by 40, you're looking at a 65% drop in those put options. That's how much money you would lose with that decrease in implied volatility. That's the risk you have when you buy put options or call options that have high implied volatility. Knowing that going into this trade, it's not just about direction of the stock. And that is why I did not want to hold this for very long. With implied volatility being so high, the stock could move down, but over time, if implied volatility was to drop, it would work against me and I could potentially lose money on this position. At expiration, you're always going to have intrinsic value. So let's go back to that put option and let's see what our best case would be if the stock was going to fall to a price that I thought it could get to. So if we go to the charts and we take a look at this, and it's going to be very basic, we're going to go back to DPro. We're going to take a look at the charts, the 5-minute chart. And what was the share price before that massive pop? That's where it could get back to $1.75, let's say. So the put option was $2.50. We paid 40 cents to get into this put option. So our break even, we don't make money on this at expiration unless this stock is below $2.10. That's our break even. Now, if the stock was to get to $1.75, So we're just going to do $2.10 minus $1.75. I can make $35 off of this put option. I made $20 off of it in just one day. I made $20 off of this trade in just one day with just a minor pullback in the stock. It didn't have to get to $1.75. So with that being said, this trade was so much better just holding short term. If the stock didn't drop and you didn't really see a move, it's still best just to sell your position because you're going to see a decrease in implied volatility and it's going to go against you. That's why in this position, I don't typically like buying put option. But with the options chain, if we go back to Webull, at looking at this options chain, I don't have a ton of flexibility. I have one put option at $5, which is deep in the money, another put option at $2.50. So for me to sell a spread and completely get rid of implied volatility, I'm going to have to pay a decent amount of money, and then my risk to reward ratio isn't worth it. So my only option here was either just to short the stock or buy a put option, and I opted with just buying a put option. But I wanted to show you the thought process in this video and things to avoid. Now, how to get an order filled, it's real simple. All you're going to do is click on the strike price, then this screen is going to come up. Your limit is going to be, before you enter your limit price, take a look at the spread between the ask and the bid. The ask price right now is 40 cents and the bid price is 45 cents. We're coming in with a limit price of 45 cents. We can actually drop that down to 40 and probably get this order filled. In addition to that, the amount of contracts, it's default at 1. Just know that per contract, you're going to end up paying what your limit price is times 100 because each contract's for 100 shares. So in this case, it's $40. Your time in force is either day or good till cancel. Options do not trade in extended hours. They only trade from 9:30 a.m. to 4 p.m. Monday through Friday, excluding holidays. With a day order, at the end of the day at 4 p.m. Eastern Time, if this order is not filled, it will be canceled. If you have good till cancel, it would look to get this order filled the next day, starting at market open at 9:30 Eastern Time. If it can't fill that order that day, it's going to redo this and it's going to repeat those steps until it actually gets filled, but up to 60 trading days. After 60 trading days, if it cannot get the order filled, it will get canceled. It will not fill an order in pre-market or after hours. It can only fill your order during market hours. When you actually have a put option bought and you want to sell something that you own, you just click the sell side and it's the same process. You pick your limit price, you pick if it's day or good to cancel, and you sell your order. It's real simple to put your order in and then you just have to wait for it to get filled and then it will show up on your positions. All right, so that pretty much wraps it up. The main takeaway here is buying put option, it's not just about trying to predict the move in the stock. It also has to deal with implied volatility and how much is already baked into the put option. If you don't take a look at that, then you might have a lot of stuff stacked up against you, and odds are you're not going to make money off of the trade. And if you know this going in, you might adjust your strategy. Like for me, I knew I was not going to want to hold this for very long. So if the stock didn't move and I wasn't in any position to make money off of this trade, I probably would have just cut my losses and looked for another opportunity because I could have gotten a huge crush in implied volatility and lost money on this put option even if the stock was to drop some. But that about wraps it up for this video. I thank you so much for your time. If you like this video and the content that I am providing, please consider hitting that subscribe button, ringing that bell, and smashing that like button. Also, please consider joining that Patreon. I'll catch you all on the next video. It's been real. It's been fun. It's been real fun. And this is We Are Investing, and together we are invincible. See ya.